When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the retirement squeeze, why it still feels tight. We'll answer a list of questions and then target date funds. Set it and forget it or not. My name is Jeff Shade. As always, I'm just here to ask the questions for you. But the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. Always fun to be with you.
Always glad to be with you as well, Jeff. And of course, all the fine people here listening to us every week on 790 KNST. Jeff, Social Security COLA is going up. The markets have been holding up, but retirees are still telling me the same thing over and over again. It still feels a little tight. What is really happening, Jeff? Is inflation kind of the real retirement story, the thing that most people are worried about?
Well, I think it needs to be currently. I mean, the thing is, all the wrong things are going up. It's not like the CPI index is going up to 8 or 10, but when you look at the price of gas going up 40 or 50% from what it was a year ago, I mean, that's a big deal. And that filters into food. Well, maybe you're not buying all those other things that are part of the index. So even though it still seems like it's in that 3 range and it's going up and people aren't happy about it, in the real world, the things that you need on a daily basis are going up at a much greater pace. So yeah, it's definitely hitting the pocketbooks of everybody. I think less probably for retirees. Some retirees on a fixed income are probably hurting, but those people that have a plan usually have a buffer that can kind of adjust to it. But I'm more worried, honestly, and this show really isn't focused on them, is my kids and grandkids and the people that are just trying to start out in life, trying to get a savings plan going where they can have more money left at the end of the month than month left at the end of the money, so they can start saving and plan for that future retirement. So it's definitely a big part of the economic woes that are happening here. And I think a lot of it has to do with some of the decisions that Trump's made regarding Iran war. Not that, if there really was a nuclear threat, it was there. I don't know. They have intel. I hope they go do things based on that intel. But yeah, it really isn't a 2-week war or a 2-week operation where you go in and scare Iran out of a nuclear weapon and everything goes back to be hunky-dory. Oil is still going to be priced high. There's been a cut in the supply, and the demand hasn't really diminished. So we're going to probably see the effects of high oil prices for a long time. I think that's kind of the driving factor. But, there's economic things ebb and flow. The economic indicators haven't really been that good. Economics overall have been getting worse and worse over the last 3 or 4 years, pretty consistently. Actually, more than that, probably 6 or 8 years now, especially over the last about 4 since 2022 when the market started crashing. It was an indication that the economics weren't really held up by much other than a hyped market, an influx of capital through government gamesmanship with banking and credit facilities and things like that are making it easy for people with money to make more money, but not making it easy for people that don't have a ton of money to buy the things that they need. So yeah, it's a concerning factor with a lot of people. I think everybody needs to understand that it's happening and maybe tighten the belt a little bit if need be, or make sure that you have some buffer in the plan. So when things like this happen, that you're not worried about it, you don't lose sleep over it.
Jeff, I have heard from many people that the big concern here is oil prices right now. Do you think that when the oil situation is fixed, that this is really going to stabilize things? Or is it a situation where, inflation is inflation, it's just going to keep going?
No, as I just, was mentioning in my first comment, the oil is kind of the driving factor of the inflation right now, and the war isn't helping. It's not just a little touch and go operation. Anytime you involve the Middle East, these guys take stuff seriously. They don't give up, and they've got too much pride to back down and make a deal. So I don't expect any deal happening anytime soon. I think the oil prices are going down based on just stuff that Trump is saying, but not what will really happen. And yeah, oil is a big driving factor of everything economically. It's where power starts. It's where your gas to get to and from work goes, to get to and from any activity. Any kind of travel is going to be more expensive. Airline travel, any kind of travel, whether it's your car or going on vacation, things like that are going to be more expensive. So, you can always adjust by not using a lot of those transportation services. And then what happens? Then there's less earnings. Then there's a dip in the economy based on the fact that oil isn't just pinching the pocketbooks of the consumer, but it's also pinching the earnings of companies that rely on reasonably priced oil so they can provide services at a economically good cost, right? Or competitive cost. So yeah, I think if oil backs down, it'll probably be a lingering effect. It always seems like as soon as oil prices go up, you see it at the gas pump like the next minute. But if oil prices go down, you don't see it at the gas pump for a month or two or many months. I think the lag is always out of favor with us, the consumer. But I understand businesses have to do what they have to do to stay profitable, to make their stockholders happy. And honestly, we're stockholders from time to time in the energy market. We were more before when it was trending up than now when it's trending down. But nevertheless, it's a big sector of the economy that we have to be mindful of. And hopefully things will get under wraps. I think the midterms coming up, there's a lot of pressure on Trump and the support staff, his regime, if you want to call it, to get this thing under control and get it under wraps. Otherwise, I think they're going to have some trouble at the polls. Every presidency seems to go through some sort of a lull or something that the public doesn't like. And I don't know why. It's just because of dumb decisions that they make along the way. And all of a sudden it's right in the middle of their presidency. And everybody says, man, we need to change. This isn't on the right track. So unless they get this oil prices and the Iran thing a little bit more figured out in the next few weeks, I think we might have a little rude awakening and that there might end up being a lame duck presidency for the next couple of years.
Jeff, inflation has been reported right now at right around 3.8%, which I think is a little bit low. When you consider inflation in your income planning, are you planning for 3.8% right now? What I mean is that most people are going to be retired more than a couple of years. Are we expecting that inflation would continue at this rate? In other words, how do you design a retirement plan that keeps up with inflation when you really don't know what it's going to be?
Well, you have to build some buffer in, obviously, and be willing to bob and weave a little bit and make some adjustments along the way. Unfortunately, inflation hurts everybody. You build a plan with as much fluff and padding and assumptions that are low. We try to shoot low and surprise high rather than shoot high and be disappointed most of the time. So when you build a plan, you have to live underneath that budget limit if you can, so that when times like this happen, it doesn't derail you or make you move so far backwards you can't recover. But yeah, retirement is a several decades long proposition for most people. And Social Security supposedly goes up with inflation, although it seems to be a little bit less than what true inflation is and what the true consumer is actually spending. Most people's pensions don't go up. But what I do find is people's lifestyles slow down as they age. And what I found that inflation in the 2 to 4% range is not so much to worry too much about, because it seems like people's expenditures and spending habits, travel habits, and discretionary spending habits go down about that much as they age into the 70s and 80s and 90s. Except for healthcare, which typically hits hard in the later years due to assisted living, things like that, long-term care, medical treatments that you might need that may or may not be covered by insurance, et cetera. So you might need that extra buffer in the latter years and in the beginning years when you're a little bit more active, but not always. But lately, we've been used to kind of targeting this 2% inflation rate, which is not a big deal, really, especially when you can get more than that on a CD or most short-term interest rates. But at 3.8, now we're talking close to the 10-year Treasury rate, short-term interest rates a little bit lower than that. So we're kind of on the verge of barely keeping up with inflation with safe money. And of course, you can't do that in a bank savings account. You can't do that in most money market accounts anymore. You're going to have to rely on some upside with the other investments in order to keep up with inflation if you want to do that. So do we build inflation in? Yeah, we build inflation in, but we also understand lifestyle changes to where you don't have to say, oh my gosh, 4% compounding annual rate of return or annual inflation rate means that every 18 years, we're going to be doubling our expenditure. So if you're 60 right now and you're spending $100,000 a year, you're going to have to spend 200 when you're 76 or 78. I don't know about that. I don't think that's necessarily going to be the case. I think as we go, we pay off debts. We learn to be a little bit more responsible, and hopefully that'll be the case. But at 2%, that means the cost of living really only doubles during maybe the whole entire retirement life. Like over 30 years, it takes a 2% rate of return takes over about 35 years in order to double your expense ratio. So yeah, 4% is definitely a bigger deal than 2% if you're going to continue maintaining the same lifestyle as you're trying to enjoy right out of retirement. But again, those first few years are typically the front-end loaded years where you want to do more stuff, get it out of the way while you're healthy enough to travel, healthy enough to maybe do those more expensive activities. And then as you age, maybe you slow down a little bit, and that might accommodate some of this inflation. But again, we don't like inflation. I don't like inflation. It is what it is. We have to deal with it. And it is a factor that comes into play when we make a financial plan. But that's why we always build some flexibility and some buffer in it. And like, if your plan allows you to live on $126,000 a year, I don't think you should spend $126 exactly. You'd probably spend $110 and leave 10 or 15 a year for those buffer expenses or those surprise things. So again, we build a reasonable plan with some buffer when we build a plan. We also make sure that income and things like that are guaranteed so that if there is a market crash or big correction because of the inflation, and typically inflation causes the Fed to want to raise interest rates going up typically hurts especially tech stocks and other things, and typically will hurt the market, just like it did in 2022. Now, interest rates kind of maintained its level. There's always the threat that they were going to go down, which made everybody happy about continuing to invest in the market. But they've been kind of maintaining themselves at these levels for the last few years. I have a feeling like Jamie Dimon, president of JP Morgan, said that he expects that the Fed will probably have to raise interest rates a couple more times before we get inflation in check. That's not a good sign for stocks, for basically anything, because inflation is obviously real, and the big bankers and basically the talking heads that know about money are talking about it, concerned about it, and are projecting that there's going to be some rate hikes. Now, that might be good for the annuity rates, might be good for CD rates, maybe for a little while, but definitely not good for cost of living and trying to make ends meet based on the cash flow that you're receiving and the stuff you need to buy on a daily basis.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management with an office right here in Tucson, also up in Mesa. If you're listening right now and you're thinking to yourself, my accounts look okay, but I don't feel secure, well, that is exactly who this conversation is for. Call Premier Retirement and ask for your Premier Retirement Roadmap review. We'll show you how to turn your savings into real, dependable income, how to deal with inflation, and how to protect what you've worked so hard for. Now, there's no cost, there's no obligation for this conversation, just some clarity. Call 520-780-9059 right now. Leave your name and number. Shelley will call you back during the week and set up that appointment for you. Again, no cost, no obligation. It's 520-780-9059. You can also find out more about us online at premret.com. It's premret.com. Jeff, when a lot of people come into you here at Premier Retirement, they've got a 401k. They've had it 30, 35 years, and maybe they don't even know what's in their 401k, or they have made the wrong choices. When that is the situation, Jeff, how do you take the money out of a 401k, maybe roll it into an IRA? In other words, how do you create a paycheck that is going to last longer than people live?
Interestingly, I think we just did an email out kind of talking about how the norm that Wall Street wants you to do is create a systematic income from market-based products. In other words, diversification, tax planning, maybe Roth conversions, maybe throwing enough bonds in there to buffer a bad year or two in the stock market, and just some real basic, theoretically sound money moves. However, with volatility, and by the way, we've seen volatility in bonds, which are still down over the last 3 or 4 years, and stocks, which have been down, have been up, and can go down at any time. The volatility factor ruins income plans. So when we talk about moving a 401k, and typically that is the biggest asset. I mean, typically, not always, but typically it's the biggest savings account somebody has because they've been building it. The employer's been adding to it. You've just kind of set it and forget it, not thought about it. You've been able to dollar cost average and grow it over time, taking advantage of those fluctuations in the stock market when the market's down to where you're still putting the same amount in every month. So you're buying more stock when the market's down. You're actually dollar cost averaging and increasing your actual return over that period of time. Problem is when you take money out, it doesn't work that way. And so let's say if you had $1 million in a 401k, or it's twice that, 3 times that, or half that, whatever, just make the adjustment in your head. But for every $1 million you have in a 401k, you might want to put, if the 4% rule says, well, the safe rule of thumb would be about $40,000 a year. Well, depending on your age, you might be able to get $40,000 a year with like $600,000. And guarantee that with just a $600,000 annuity product that guarantees income for life, regardless of how that particular product works. The $400,000 you could leave in the market, not have to worry about the ups and downs. Market averaging 10% a year, that means potentially doubling. Or let's just say you have a blend that averages 7. Let's say it doubles every 10 years. That means in the next 20 years, your 400 is going to be now 1.6 million. Yet you've still had a guarantee of that same $40,000 a year that Wall Street said would be the max you should be able to take out. Well, if you can leave your market money alone, you don't have to worry about the negative effects of volatility on an income plan. So we divvy up the retirement plan. We divvy up the Wall Street money into fixed account money that generates income at a much higher rate of income than a volatile asset possibly can do. And actuarial, I mean, if you look at any actuarial or statistical analysis of it, everybody will agree. I mean, 4% is even a little bit rich to be expecting to take it out. If we had another decade like the lost decade of 2000 to 2010, where we have 2 market crashes, one from 9/11, one because of the dot-com bubble, which was out of control, which looks like AI might be following in the same footsteps. Too much hype and not necessarily earnings as of yet, projected earnings, but some companies are rising to the occasion and some companies aren't. At least there are real earnings in the AI movement so far, and it requires chips and other technology. But the .com was, there was a lot of companies that had no revenues and no income and just had a .com after their name, and that blew up. Well, it ended with another 9/11 situation, which tanked the market again after the 2000 crash again a couple of years later. So, it did come back. And then what happened? The banking fiasco, when banks were rating their own bond portfolios and lying about how strong they were and faking it out and not worrying about the ramifications that there'd be a market crash. They caused it, and it happened. Government bailed them out with printing money. If we went through another situation, maybe we could say, well, we learned our lesson. We'll never have that again. Thing is, every time we say it's different this time, it turns out to be the same. It just takes a different form, or it just works a different way. It's just not because of the banking or the AI or because of a 9/11 World Trade Center bombing or something. It may be some different thing, but whatever it is, cycles happen, markets correct, we're going to see more correction. So bottom line is we have to prepare for the what ifs. And in a 30-year retirement, which somebody 65 living to 95 is bound to have to plan for at least 30 years. And you might even live longer than that. You never know. If you retire earlier, you've got even a longer term to deal with. So, depending on how you planned and depending on what happens, I think if you take that 401k and divvy it up into different IRA buckets, one or two that include income, the income bucket could be converted to a Roth. And we have some really cool software. Bottom line is I can probably do it in my head, but we have some backup software that basically verifies that if it makes sense to do an accelerated Roth conversion program where you convert your IRAs or your 401ks to Roth, pay taxes now and then never have to pay tax on the future gains or the future income off of those accounts. So we also use LERPs, which are outside of IRAs and 401ks for those people that have, let's say, a sizable amount of money in the stock market. And every year you get this surprise tax bill. You never know what it's going to be. You have a good year, and let's say you have $500,000 in a brokerage account and you have a good year, it makes 10%, you have $50,000. That might kick you into a new tax bracket. It might actually kick you over the limit for the IRMA, doubling the IRMA, which is your Medicare premiums. Maybe you have more than that in non-qualified assets. You have a 20 or 30% year. Shoot, we had growth funds that did much better than that last year. And if they're traded or mutual funds, although mutual funds probably won't keep up with that type of return, but if you have a good rate of return, you got to pay tax on all those gains as short-term income typically. So, do you want to control your tax situation or not? So those non-qualified assets, we would also address and put into non-taxable buckets or flexible buckets. We call it infinite banking or do your own bank on a tax-free basis. If you could have a bank account and everything was tax-free, growth, income, and everything else, and then when you die, it all goes to your heirs tax-free, that sounds like a pretty good bank. Well, you can build that yourself through LERPs, life insurance retirement plans. I know some people in town don't understand them, don't get the benefit of them because they love the sound of cha-ching, cha-ching, cha-ching fees on your managed money forever. But sometimes the stability of an annuity that pays you income forever and doesn't continue to generate fees for the rep or the broker dealer or your advisor, but sets you in a place to where you can be maybe a little bit more aggressive or not worry so much about the money that is managed or the smaller portion that might be fee-based that is continually generate fees, but also your flexible money that can be used for discretionary expenses when the market's good and just be left alone when the market's not good. So you can wait it out, or you can just let it grow in an account that you want to pass on and leave as a legacy, whatever. Again, there's different buckets that you can put your money in. They serve different purposes. Some are tax-free income, some are tax-free legacy, some are taxable income because you still have a little bit of buffer and to stay in this a low tax bracket, no big deal. Guaranteed income is, in my opinion, the peace of mind that you deserve in retirement. And it's really the only way you can retire on your own terms. I see so many people that have tons more money than they need to live on, but they're just scared that because of the next market crash, if their $3 million became $1.5 million, they would be living kind of on a nip and tuck basis. Well, why don't we just take the $1.5 million out, lock it into income, and then not worry about the other $1.5 million and not lose sleep and still have the same amount of income, knowing that you can't lose the income and you don't have to touch the other half for income if something should happen. So again, every bucket or every asset class should be set up to perform a different, it's kind of like an employee. That money works for you and you give it a job, you give it a job description, and that's what it's supposed to do. You don't say, well, you guys are all employees and we're just going to change your job description every time the market or whatever changes and just be ready for your next bit of instruction. Well, that's kind of hard to work on that basis as an employee. It would also be hard for your money to work on that basis. You'd always have to stay liquid. You'd also have to keep maybe too much in safety and not get the returns that you deserve because there's no principal protection guaranteed on securities. Interesting, they call everything with risk a security because it's not secure. But bottom line is the 401k can be divvied up into different IRAs. We can convert some to Roth, and we can generate an income plan that keeps you in the right tax bracket and still leave you enough room for some growth aspects if you want to leave a legacy or just for the rainy day in the future.
Jeff, when a client of yours sits in front of you, do you do all the retirement planning for them, or is it a collaborative effort? And what I mean by that is, how much input does the client have? Do they do some of the work? You do some of the work? Do you do all of the work, or do you just suggest to them what to do?
Well, as an advisor, we suggest to them what to do. I will say as an advisor, if I give a lot of advice and they never do what I advise, we're not going to have a very long relationship. It's not going to be mutually beneficial. I mean, it's going to be frustrating for both parties, but you're free to take the plan or not. What happens is we collaborate on your values, your goals, what money you have, what you want to accomplish. And then we show them what has made over the last 40 years, our clients the happiest, the ones that are still with us and still smiling when they come in for reviews. We try to build a plan like that based on their parameters, based on their goals, their desires, and their rules that they want to keep in mind. So if it is a exact opposite of what we do, like we think safety and income is first, taxes right all in there. But if they come and say, well, I just want to make 20% a year and be able to live off it and never lose money. Well, that's not even real. And we're not going to promise we can do that. We're not going to build a plan that does that because a plan over the next 30 years doesn't exist that will do all that. It might for a period of time, it might for a year or two, but it doesn't do that. So again, we get together and 2 or 3 visits later, we say, hey, this is the kind of the plan that we've come up with together. You want to jump on in there? Let's do it. Let's do the comprehensive plan. There have been people that have said, you've got enough gold to be a central bank. Some people are a little bit maybe over allocated into things like gold and silver that have run up. It's okay to take profits from time to time and that kind of thing and still have a bunch. I'll suggest that people take profits. Sometimes people that are really set on a certain asset and they want to keep it in their safe, they don't want to sell. That's fine. We build the plan based on things that they want to maybe handle themselves or not deal with. But generally speaking, we build a comprehensive plan. And if you don't follow it and you make a big blunder in one of the sections, hopefully it's not going to derail the whole plan. That's why we have different buckets of different types of money, so that if one doesn't work out as well as we had hoped, that there's other things. If there's 4 legs on a table and one's broken, the table can still sort of stand on 3. But if you start breaking 2 of them, it's a lost matter, right? So it's just not going to happen. So we got to have at least enough stuff that's guaranteed to work and maybe some discretionary things. And I'm not opposed to discretionary things for a client to make their decisions on. But if they decide to go with the plan and then don't do the plan and somehow it doesn't work, then let's not blame the plan or the planner. Let's say, oh, well, shoot, we thought better. We thought maybe we could adjust the plan and do better. It didn't work. Oh, well, maybe we ought to get back to the plan or find an advisor that speaks your language because maybe we don't communicate well together. I mean, I'm not the perfect person for everybody, but I try to be the perfect person for those people that have accepted our planning style, the plans that we've developed for them together with their collaboration, and move forward. So, if we come back and meet on an annual basis or more frequently if need be, they see that the plan's still working, that they still have as much money as they expected to or more, that's a good thing, or that they're still in a position that they're not going to run out of money, even with a bad year that might have happened last year, or even with a future bad year. So we all go, you always put in the things that have happened, the things that could happen, and make sure the plan is intact as we review it on an ongoing basis. There might need to be some tweaks. I may make some suggestions of people to make tweaks. Some people don't. Some people want to spend all their money before they're 80 and live on Social Security after that. Well, if that's in your plan, that's your plan, then don't be mad at me when you're 85 and only living on Social Security because we made the plan work. Or if we beat the plan, there might be some money left, and generally speaking, there would be. But at the same time, you've got to be cautious about overextending income and maybe overdrawing on a plan that's based on conservative returns, because there may be conservative returns. Shoot, we had a lost decade in the 2000 to 2010. What if we had another one and you're drawing down assets? You need to be a little bit careful that it's not going to derail your plan because we have a few bad years or even 2 market crashes in a decade. Again, we've got history that shows us some of the things that we need to do and things that we need to worry about. And as long as the client wants to get on board, we hope that they want to stay on board and that they stick with the plan. If they don't, then obviously that's on them, not us.
Great conversation, Jeff. Let me talk to our listeners here for just a moment. If your plan is still assuming low inflation, low taxes, smooth markets, you don't really have a plan. What you have here is a great big guess. So call us here at Premier Retirement right now and ask for your Premier Retirement Roadmap review. No cost, no obligation. You'll simply leave your name, telephone number. Shelley will call you back and set up that appointment for you. And as I said, it's not going to cost you a dime. Find out if your money can actually support your lifestyle or if you're headed for a slow squeeze. Call 520-780-9059. As I said, you can do it right now if you want. 520-780-9059. We're also online at premret.com. Jeff, let's take a break for news and weather and sports and all those great things. And when we return here on Premier Retirement, we'll answer listener questions. And then later on today, we'll be talking about target date funds, good or bad. All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan. And you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for making us a part of your weekend. Of course, you're listening to Premier Retirement with Jeff Vogan, and my name's Jeff Shea. Glad you could join us again this fine May weekend. Believe it or not, June is just around the corner, and I want to remind you we're on the air for you 4 times a week. On Saturday mornings at 7, 9 a.m., and then Saturday afternoon at 1 p.m., also Sunday mornings at 11 a.m., and as always, we're online 24 hours a day, 7 days a week, 365 days a year on our podcast platform. Go to wherever you get your podcast, search for Jeff Vogan's Premier Retirement. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. If you would like to request your Premier Retirement Roadmap, absolutely no cost and no obligation. It's just a casual conversation with Jeff to put you on a path towards a confident retirement. Once again, 520-780-9059. Okay, Jeff, time for listener questions. We'll start it off with Edward in Vail. And Edward says, I'm about 5 to 10 years away from retirement and currently at roughly 75% U.S. and 25% international stocks, drifting above my 70-30 target. With recent data showing declining global sentiment towards U.S. leadership, I'm wondering, should that factor into my allocation? Is foreign sentiment something investors should act on, or is it mostly just noise compared to the fundamentals?
Well, I think there's a lot of noise running the market, and I don't know if there's any fundamentals anymore. I think it just matters you follow the money. And the reason that you're 75-25 instead of 70-30 is because the U.S. market's stronger. I prefer to put my money wherever it's strong. If the international is taking a break, then we would get out of it and go back in. If you're just a set it and forget it guy, then you set it and forget it and just see what happens. But if you're actively managing it like we do, then you probably would be dialing back some of that international stock in favor of some of the up-and-comers in the U.S. that's driving the market right now, semiconductors and things like that. The nuclear-focused energy for data centers and things like that are still strong in spite of the fact that they have zero fundamentals. So again, the stocks that are going up don't have the fundamentals, in my opinion, that they have some growth, but earnings aren't there. And there's no guarantee that they're going to own as much market share as they think they will, or that there's going to be that big of a market to share between so many companies that are trying to get a piece of it. Kind of like the dot-coms that bombed. But there's going to be some that are going to rise to the occasion and come out the biggest winners. We tend to look for those specific ones, those specific stocks. And if you want to look at international, we prefer ETFs rather than just individual stocks. The ETFs typically focus on countries. Certain countries' economics are doing better. Korea's been doing crazy good this year. For example, Peru's been good lately. Argentina's been good. Last year, I think, some of the European countries are good. Spain, Italy, and Austria were strong. So you can follow the money and see the trends. And if you follow the trends, get more international stocks if you like what the trend is doing, or get more into U.S. stocks. I don't think there's a balance that you have to be in a certain allocation unless that's just your kind of thing or a rule of thumb. But if the U.S. stock market starts falling, I hope you're not 75% in U.S. I hope you go to some short-term bonds for cover, or maybe even focus on what the exchange rate between the dollar and other countries' currencies are, and maybe focus on those countries that are a better value, not necessarily because their economy is growing, but because the dollar and the currency exchange of that country are favorable to that. There's all kinds of ways to make money in the market. Some of it's a little bit luck, just being in the right place at the right time. Some of it's based on fundamentals and future growth and expectations that actually pan out, and some that don't, unfortunately, that was hanging. So again, we believe in being vigilant on a portfolio. If you're just trying to leave it allocated, then I would just basically divide that 75% or the 70% amongst some of the indexes and not worry about it. And then the international stock just go on some of the emerging growth. I think it still has some promise internationally, more so than I think maybe even the blue chips. It just kind of depends what you're looking for. But the decline in global sentiment towards U.S. leadership, I don't know that it's any better to foreign leadership. I'm disgusted with all leadership. So I don't think that matters. It just really matters where the money's going. Are foreign countries buying our stock regardless of the U.S. leadership? Well, then it's a good thing. Is U.S. leadership creating a situation where they're telling us where the money's going by propping up companies like Intel or Quantum or some of these other companies that they want to get more involved in with the sovereign fund and so forth? I mean, follow the money. You don't have to like or hate U.S. leadership. Shoot, most people, if they're party affiliated, hate every other president that's not of their party. Are you going to get out of the stock market every time that happens? Probably not. We just have to read what's happening. And again, it's just about following the money, following the momentum. We like the momentum. We like the trend that's returned to up. It is very thin, which scares me a little bit, to be honest with you. And it just reeks of nearing a top end where there's going to be this euphoric buying where companies are doubling, tripling in a matter of months that really have no fundamental reason to do so other than hype and stuff on TV that says they should. Yet you've got good blue chip companies that are down 20 or 30% that actually have earnings, have fundamentals, have steady growth over the last few decades even, and people are forgetting about those stocks. So are you a long-term investor? Are you going to use this money for income 5 to 10 years away from retirement? It means you probably have some staying power. But if you took half of what you have saved, you could guarantee at least income on the total amount you save, because there are annuities, for example, that with half of the money you've saved, let's say you have $1 million, you put $500,000, it'll be worth at least $1 million in that 5 to 10 year period as far as an income plan goes based on an annuity payout. If the market crashes, you'll be really glad you pulled some of that money out and had some guaranteed growth in the meantime. It'd be terrible if the next 5 years is great, then it crashes and you say, oh, shoot, I thought I was going to retire in 5. Now I do have to go another 10 to hopefully ride the market back up so I get my $1 million back that I could have just taken off the table and set something up. So usually when people get to 5 to 10 years from retirement, I believe in taking a bunch of that profit off the table, setting up a bucket for your money for income that's guaranteed, and then dollar cost averaging back into the market so that if the probable corrections come that are historically going to happen, I mean, if you look at all the data points from what's happened in the past, the precursors to every market correction or crash, we're looking at them again. And if everybody says, well, it's different this time, they're wrong. It's never different this time. It might take a different shape or form, but it always happens. So we're probably due for a good correction in the next 5 to 10 years. I just can't see it not happening within that period of time. I mean, we're due. So consider taking some of that profit off the table, maybe locking up some income, some tax efficient income growth, maybe doing some Roth conversions if you're not in too high of a tax bracket while you're finishing up your working, maybe dollar cost averaging in with new money to see if you can build some extra wealth between now and the time that you actually retire.
Edward, very good question. We appreciate you listening to us in Vail, and I think Shelley's got some Retirement The Road Ahead books back there. If we've got some, we'll send that out to you. And again, if you would like to further the conversation with Jeff, it's 520-780-9059. Okay, Jeff, Bruce is in Catalina Foothills, and Bruce writes, I'm 51, a high earner, and I donate about $40,000 to $50,000 a year to charity. Most of my savings, about 85%, is in a taxable brokerage account that's kind of messy with individual stocks and tax-inefficient funds. Does it make sense to use donor-advised funds to donate appreciated shares, simplify the account, and then reinvest my cash into a cleaner, more tax-efficient portfolio?
Yes, yes, and yes.
Okay.
You're thinking along the right line, Bruce. First of all, individual stocks, if most of your savings is in taxable brokerage account, that just means you don't have a clue what your taxes are going to be, and it's all going to be taxed, especially if it's in a brokerage account where they trade a few times every year, or in mutual funds that pass through all the trading activity, and you get this surprise tax bill, usually in February. And typically you can look at it during the year and kind of see where you're at or see where you're headed and make some plans, but that doesn't help you at 51. The good thing about that is it's not going to affect your Medicare premiums, but it will affect how much you get to save because you're spending potentially 40% a year in taxes on all the gains on that portfolio. So if you're making 10% on average on your risky portfolio that could lose half of it in the next market crash, what if you did exactly what you said, do a donor advised fund? You can actually deduct up to half your earned income. And let's say if the 85%, and I'll just use the round number million. So let's say $850,000 is in those funds, and you get $40,000 to $50,000 a year. What if you put $400,000 of the most appreciated stock of that $850 into a donor advised fund? I don't know if you're making $800,000 now, but over the next, let's say 4 or 5 years, you get to write that off against half your income. So if you're making $400,000 a year, now you only have to pay tax on 200 minus your deductions. Shoot, you just got back to the 22 bracket. You filled up the 12 and a little bit in 22. Should be doing good. And then you get to take, in the future years, you get to continue to get your entire standard deduction rather than have $32,000 of it, if you're married, wiped out in a $40,000 to $50,000 charitable deduction that you only get about 10 or 20,000 of, because 30,000 is standard deduction anyway. So donor advice fund, very, very tax efficient, probably save you 10 grand a year in taxes on average at a higher earned income rate. And the other thing is reinvesting the rest of the cash in a cleaner, more tax efficient portfolio. I talk about LERPs a lot. And if you think about paying tax as you go on a, let's say a 10% rate of return that could actually crash, but you did a LERP life insurance retirement plan, you can make 6 or 7% tax free. And rather than pull the money out when you use it, it continues to grow and you get to borrow against that growth. That's actually more efficient than muni bonds. It's actually more efficient than an after-tax stock market account that could lose money as far as the income that'll produce for you over any period of time than anything I've seen, especially on a tax equivalent basis. So if you want to look at something that's very clean, never generates a 1099, keeps your income looking very low, only worrying about taxes on those assets you take out of your IRAs when you retire, or income from a pension when you retire, or Social Security, we can basically look ahead 10 years or so when you plan to retire. I don't know, I assume probably in your 60s, but 10 or 15 years down the road, we can project you to be in the lowest tax bracket instead of the highest tax bracket like you are right now. So yeah, planning is essential for people in high tax brackets, especially tax planning. And if you're not taking advantage of a donor advice fund with that kind of contributions every year, you're really missing the boat. You're losing probably 10 grand a year in tax savings.
Bruce, thanks for listening to us in Catalina Foothills. Once again, if you would like to continue this conversation with Jeff, 520-780-9059. Leave your name and number, and Shelley will get back in touch with you. Again, no cost, no obligation, 520-780-9059. Okay, Jeff, John is in Tucson, and he writes, my wife passed away at age 66 after a chronic illness. My question, which I can't seem to be able to find the answer to, am I entitled to Social Security survivor benefits? I just turned 64 in November. I can maintain my lifestyle without a survivor benefit, but if it were possible to get the benefit and delay mine, it certainly would help. Certainly, I'll be hitting IRMA when I transition to Medicare this coming November, since I'm going to be single. So he's just curious, can he or should he access his wife's survivor benefit? And again, he's 64, his wife was 66, so she was getting Social Security, but he wasn't.
Well, and that you can't get the survivor benefit, but if your earned income is higher, and if you're not at full retirement age, you're going to make an adjustment to what they give you and what they withhold. So my favorite strategy in this case is, even though you could get it and end up giving some of it back or not managing it, the best way to manage it, let me just say, is wait till full retirement age, take the survivor benefit. You're going to be in the higher IRMA anyway, but so what? Use it to pay your bills, and then you can wait on your own to age 70 and get the full age 70 amount. If you take retirement early, then you get an adjustment to the early payout, and that affects your future withdrawals as well. So you don't want to hurt yourself with the Social Security. Go down there, talk to somebody that walk you through the benefits. But there are some aspects of somebody that's working pre-retirement where you may end up hurting yourself more than helping yourself if you take it before full retirement age.
John, good question. And again, if you would like to continue this conversation with Jeff, 520-780-9059 is the number. And certainly we would be happy to meet with you. Listening to the program today, and you've got a question you'd like us to answer on the air, you can get it to us by calling it in to Shelley, 520-780-9059. She'll get it over to us, or you can go to the website, premret.com, premret.com. Leave your question there. And if we answer it on the air, not only will you get a great answer, but you will also get Jeff's book, Retirement, The Road Ahead. Okay, Jeff, let's talk about target date funds. Set it and forget it. You pick a year, you throw your money in, and you're done, right? Well, maybe not. Well, today we're going to break down whether the set it and forget it investments are really that simple, or if retirees could be taking on more risk than they realize. So, Jeff, first of all, let's talk about target date funds. Are they as easy as they sound?
Well, they're easy. Yeah, I mean, bing, that was easy. You could hit that button, but they're not necessarily very efficient. I think the target date funds are run by managers who are just getting into the business that they just hired to learn about managing portfolios, and hopefully they cut their teeth on them. They don't tend to perform that well. They don't even perform as well as just buying the index, in my estimation, every time I look at them. So let's say a target date fund would be, I'm going to retire in 5 years, target date 2030, let's just say 4 years, just to make it a round number, because usually they go in 5-year increments. So you're going to retire in 2030 and you're going to have 50% bonds and 50% stocks. Well, if you'd had that portfolio, 3 or 4 years ago, you'd have lost 20 or 30% in the bonds, which would have been half your money. And then the other half of your money would have lost and then come back. So you'd be making money in some of the market stuff, but you're still treading water on half of your money. So that doesn't make a whole lot of sense. Yeah, you'd be up a little bit, but if you're managing your own 401k and you could invest in bonds or stocks, when the stock market's rolling, why not put more in the index and put the safe money rather than in long-term bonds that they typically invest in that can go down 20 or 30% if interest rates go up or if the Fed's required to raise them again, which Jamie Dimon thinks it'll happen. Just based on the inflation numbers, it's logical that it will happen. If interest rates go up, long-term bonds lose money. You're going to lose a bunch of money to offset any gains you make in the stock market on that retirement 2030 or 2040 fund, whatever it is. So again, it's just not efficient. They don't seem to work. My opinion is follow the money. Right now, the small cap stocks are outperforming every other index, the Russell 2000, IWM, IWC, small caps are outperforming most everything else. So if you have an option to do that in a 401k, then you should do it. Not just set it and forget it and hope it all evens out in time. But, if you're not really savvy on investments, maybe you don't really have another choice. But some people come to us before they retire to get us to help them allocate their 401k based on the current markets. We're happy to do that. What happens usually is people endear themselves to our company and what we do and buy into our philosophy of safety first and the trend is your friend and don't be in things that are going down. And let's create a tax efficient portfolio and a future income plan. So typically, as we service people that have 401ks and don't know what choices they have, they end up liking us. And when it comes time to move that and to reallocate into an actual retirement plan, typically they already know about us and have something in mind and feel confident moving forward. So we love to offer that service. It's not a big deal to look at your portfolio and look at your choices and give you a little bit of guidance that way. But the set it and forget it, I know people use those target date funds because they seem easy. In fact, there's some 401ks that's all they offer is you just pick it. It's because it's easy for them, yet they're happy to charge you fees and do absolutely no money management. Don't do anything to earn your fees. They just charge it to you and say, well, these are your options. Good luck. Hope it's worth something when you retire. You can be a lot more proactive with your retirement plan if you want to be. And I would suggest looking at the options before just settling on the target date funds.
Talking with Jeff Vogan about target date funds. Again, 520-780-9059 is our number. Jeff, do a lot of target funds lean heavily to having bonds in them? And how have bonds performed over the last 2-3 years?
Well, interesting. Even the longer target date funds seem to have some bonds. I think the lowest I've seen is at least 20% in bonds. And bonds have not performed. As I mentioned a minute ago, they really haven't been doing that well. I think the aggregate bond was down 20% and kind of stayed down for a couple of years. And last year went up about 6%. I think it's pretty much flat this year. The 20-year bond, I believe, is still 20 or 30% lower than its peak a few years ago. And so there's a lot of, I don't know why you'd have bonds. Now, bonds, that's the biggest asset class out there. There are so many bonds. And bond traders run to bonds for safe havens. But, you have billions and billions of dollars and you can ladder a bond portfolio and know that you're going to get a certain amount of income every month. Then maybe you don't really care about the value of those bonds. And that's what insurance companies do. You might want to use your money on a regular basis and you don't want to be taking some of the principal out of those bond accounts that are down at the time that you need your money. For year to date, the bond market is down about 1.25%. So if the average return is 4, which is kind of the aggregate bond yield right now, the average return is 4 and you're down 1.25, you're really only up 2.8 on an annualized basis, right? If you actually think about it, you're actually up only about 1.6 on an annualized basis because that 1.2 down, if it continues that downtrend by the end of the year, you could be down 2.5 on a 4% portfolio. Well, if you've got to pay a manager or even a 401k manager 1 or 1.5%, you make 0 on bonds even after the interest if we're on a current trend. If you look at from a year ago, we're only up less than 1%. From 2 years ago, up 2%. From the last 5 years ago, this is the aggregate bond, that's short-term, long-term, everything in between, is still down 14% from 5 years ago. So if you've had bonds for the last 5 years, you're still down 14%. Look at the opportunity cost that you could have had by just being in things that, have upwards momentum. So if you're not watching it or not savvy, you don't know what to look for, obviously you might not have a choice other than to say, I don't know what I feel comfortable with. I guess we'll just do the target date funds. That what they're meant for is people that don't know anything and we can just get a fee for doing no management. That's kind of what the companies that offer them, I think, do. And unfortunately, it's really not in the people's best interest generally. If you want to look at even a more horrible bond, if you look at the long-term bond, the 20-year and 20 to 30-year bond, if you look at the last 5 years, that's still down just shy of 40%. In the last 2 years, it's down 6%. Last year, it's down 1%. Year to date, it's down 2.5%. Last 6 months, it's down 6%. So, I mean, bonds are, in my opinion, a losing cause. I hate bonds from the standpoint of owning them directly. I love bonds if a company like an institution, like an insurance company, is going to ladder bonds. They know they're making 4 or 5%. They're getting paid every day on a bond, and they're only dealing with the interest. Let them take the risk on bonds, and you can use the interest without any of the downside risk with insured products, annuities, LARPs, life insurance retirement plans. They basically are principal protected because they buy the bonds. They only invest the interest. They wait the term of the bond out, so they know exactly what they're going to make. They don't have to cash them in at a loss. And that's why insurance companies can stay in business so long and still be the fat cat on the financial institution realm of financial institutions. Banks are always borrowing everybody else's money and loaning out more than they need to, having to ask the Fed for more money. But if you want to be involved in the bond market, let somebody take the risk of those bonds off your shoulders and still have that safety feature that bonds provide, which is your money back at the end of the term plus a certain guaranteed rate of return. But unless you're going to ladder your own bonds and managing yourself, which is a pretty big endeavor, unless you're a big hedge fund bond manager, like Jeff Gundlach or somebody like that, or Bill Gross from PIMCO, those guys, they can manage huge trillion-dollar portfolios if they want to. But if you're just managing your own, I just wouldn't get into bonds, or I wouldn't get into those portfolios that force you to have a bond portion, which is heading down and continue to be in a downtrend, even over the last few years.
Jeff, you mentioned it earlier, and that was fees. People often overlook those.
I don't know that they overlook them. Some people are super fee weenies and too worried about the fees they're paying instead of the results that they're getting. Now, a fee is worth it if you're getting some results or some benefit from it. We believe we add tons of value just in the tax planning aspect alone to earn our fees. The other thing we do is we actually manage, buy and sell the stocks and the ETFs and things that have zero to very, very little fees. But I find, though, people come in and they're paying their broker, their advisor, 1 to 1.5%, sometimes more in fees. Somebody was at 1.5%, but then they had this minimum portfolio fee of $6,000 a year, and it was only a few $100,000 portfolio. And so it was that plus the fees, and they can be nickeled and dimed, and they are disclosed somewhere, but they don't understand why these fees are coming out. The thing that I really don't get is why somebody would charge you a fee and then just stick you into a mutual fund, which is managed by a manager. All the buys and sells are done by somebody else, and they're still charging another 1%. The only reason I would buy a mutual fund would be a very short period of time because somehow the manager found some momentum and has some stocks in there that's easier to just buy the fund for a short time than it is to try to figure out the top 10 stocks in that fund and buy them individually and try to watch them on a daily basis. So on occasion, we'll use a fund, but not for the fact that we're going to just park it and hold it. But what I see is so many funds are just kind of park and hold. One thing, I'll just call them out. I use Fidelity a lot for our custodian to hold our funds. They're very easy to work with. They have really high security. We really like the interface that we get with them on our trading platform, how quick they get things done and how inexpensive it is to transact stuff on the institutional level. However, there is kind of an interesting thing, really self-serving. There's like these advisor people that they call themselves fiduciaries at Fidelity, and they are independents like me, and I could just say I'm a Fidelity fiduciary, and I'm going to charge 1.5% for my services, and some of them are 1 to 1.25%, 1.5%. And typically, the people I see have at least $1 million in order to get access to these super cool fiduciaries, and they charge them a percentage, and then they get them into these low cost, like a advisor's tech fund that only has a 0.5% mutual fund fee. And they say, well, I'm an advisor, I'm going to pick the funds for you, and we're going to get these funds that have a lower fee than our regular funds. Well, interestingly, those funds that have a lower fee than the regular funds are full of the regular funds that have fees. So if you add them all up, I went in Yahoo and I added it up for one of these people that just really loves his cute advisor that tells him that I'm full of baloney. But Yahoo says, look, this girl's getting 1.25%. The fund that one fund that he's in is 50 basis points. So they're up to 1.75. And the average fund in that fund is about 1.1%. So we got, 1.25, 1.75. Now we're at 2.85, almost 3% in fees. Now 3% in fees definitely adds up in a very, very big way over time. And they're really not doing anything to manage it. You could buy those exact funds that are in that advisor fund and save yourself almost 2%. Right there and do the same thing yourself. You don't need an advisor to buy you the same things you could buy unless you just really have a hard time choosing. But those advisor funds typically are pretty diversified. It's like they choose 20 of every fund that, between them, they all have kind of the same funds in them. So you could pick a 20% portfolio and probably randomly pick it from Fidelity and get the same type of results.
Jeff, hate to cut you off, but we're running out of time this week. If you've got a target fund in your 401k and you're worried about fees, you may want to take a closer look. We can do that for you here at Premier Retirement. Call 520-780-9059 and talk to Jeff. No cost, no obligation. We would love to hear from you. Jeff, thanks for your time, but I want to thank our great listeners here in the Tucson area for joining us as well. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. Join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.